Optimizing 280E deductions for cannabis retailers and dispensaries is the key to lowering tax exposure and boosting profitability. IRS Code 280E was intended to prevent drug traffickers from claiming tax deductions for business expenses. With cannabis still illegal from a federal perspective, legally operating cannabis businesses cannot make many of the standard deductions mainstream businesses enjoy. As a result, cannabis companies face much higher federal tax rates than other industries, as much as 40 to 80% more in taxes, while the corporate tax for traditional industries is 21%. With taxes set to rise in California and other markets, it is more important than ever that retailers and dispensaries understand what they can and cannot deduct to lower their 280E exposure. In the following video, we will show how cannabis retailers and dispensaries can limit their tax exposure while complying with 280E. We'll discuss how to analyze cash flow, properly plan and optimize deductions, and provide instructions on how to make sure your documentation supports your position in the event of an IRS tax audit. If you're vertically integrated or a cannabis cultivator, be sure to check out our guide to 280E deductions for cultivators. Now, before we dive in, be sure to like, share, and turn on notifications for more cannabis news and updates. All verticals in the cannabis industry are affected by IRS Code 280E and the limitations around reducing tax payments. Because 280E directly relates to the sale of or trafficking cannabis-related products, the rule most influences retail and dispensary operations. It is essential to have a deep understanding and organized seed-to-sale structure to minimize the tax burden. By identifying which deductions you can allocate as a cost of goods sold or COGS, operators can significantly reduce the impact of 280E on their retail establishment. Our industry professionals assist operators in maintaining accurate inventory by applying the inventory accounting method. Dispensary operators are the most limited vertical for allocating expenses under cost of goods sold or COGS. For retailers, the cost of goods sold is the product's initial purchase expense and any costs associated with acquiring the cannabis, including transportation expenses. Now, operators must keep accurate records to track and code direct and indirect costs properly. Retailers who work within other verticals in the industry must correctly document expenditures associated with operations of each vertical. This sample profit and loss sheet demonstrates the disadvantages retailers face in the cannabis space. The orange highlighted areas, rent, utilities, insurance, and maintenance, are all deductible costs for organizations outside the cannabis sector. The green highlighted cells are deductible expenses for both industries. As a result, the cannabis retailer has the same expenditures, but their profits are about half as much as the non-cannabis retailer. Why? Because they cannot take the same deductions available to typical retailers and minimize their tax exposure. Therefore, they end up paying more in taxes. So in this example, the cannabis retailer owes $75,000 more in taxes than the non-cannabis industry operator. Direct expenses for cannabis retailers can often be deductible if you can prove they relate directly to the production of goods, and therefore fall under the cost of goods sold. Since COGS are the only deduction under 280E, it is crucial to understand and allocate costs accordingly. Retail operators can claim deductions for the following direct costs: invoices for product, for COGS, cartridges, CBD, edibles, flour, freight, labor related directly to production, example, the bud tender hourly rate for rolling joints, packaging, lab testing, security, shake and trim, tinctures, and transportation, but only the expenses associated with travel to buy cannabis products and legal shipping costs. Indirect costs are not generally deductible on the cannabis retailer's business tax return, although some are considered mixed costs, where a portion of the expense may be tax deductible. Determining the correct allocation is complex, and we recommend the assistance of an experienced accounting professional. Depending on your business model, the following costs are sometimes deductible: cleaning expenses, computer, telephone, and internet expenditures, insurance for liability and workers' compensation, interest expenses, lease software, office expenses, payroll processing fees and payroll taxes, rent, and utilities. However, electricity used in sales areas is not deductible. These following indirect expenses are never deductible for cannabis retailers: website design, charitable contributions, meals and entertainment, franchise fees, banking service charges, and advertising and marketing. Operators can streamline 280E deductions by working with a team of professionals to help identify, track, and allocate direct and indirect expenses accurately. Having methods specifically developed for the cannabis industry, such as timesheet software, can help automate the process and cut down on manual tracking for labor deductions. Unlike technology for general industries, cannabis system structure supports the regulatory challenges operators face in the cannabis space. This is also extremely helpful in the event of an audit. Operators can show reports of allocations and provide detailed accounts to the IRS. We also recommend working with a strong team of cannabis accounting experts. Identifying 280E workforce deductions can be challenging, and incorrect allocations can lead to audit investigations, where the IRS can assess penalties and fines to organizations operating outside of regulatory standards. If managed correctly, retailers can increase their bottom line by lowering tax liabilities. To determine your individual business needs, operators can schedule a free consultation to discuss how GreenGrowth CPAs can assist your cannabis retail establishment in navigating the 280E deductions. In the 1980s, legislators initially passed Section 280E to prevent traffickers or drug dealers from writing off business expenses on their tax returns. However, it was never meant to apply to legitimate businesses operating in accordance with state laws. While cannabis remains a Schedule I drug under the Controlled Substances Act and illegal under federal law, the industry will continue to see the adverse effects of 280E. Today, lawmakers urge President Biden to assist with cannabis legalization and industry reform. While Democrats continue to exhaust initiatives asking Congress for cannabis reform, cannabis legalization has become a bipartisan issue across the U.S. Republican legislators are joining their Democratic counterparts and recently submitted a bill to Congress proposing the legalization of cannabis. While legalization would make the IRS Code 280E obsolete, it would also significantly impact dispensary businesses operating across the United States. If cannabis companies are allowed to take typical tax deductions, they can invest more into their operations and the communities they serve through higher wages, better benefits, more community outreach, and better education for the consumer. For more information on navigating the 280E, reach out to us today to our financial experts at GreenGrowth. We are here to help your cannabis venture through any level of the tax filing process. We employ several financial programs that can assist your company with fiscal responsibilities, including tax planning and compliance, outsourced CFO support, audit preparation, tax controversy support, and much, much more. For recommendations and assistance with an IRS audit, schedule a free consultation or contact us at 1-800-674-9050. Thank you so much for your time. We hope this information has been helpful. If you have any questions or want more information, please leave us a comment below. And be sure to like this video and give us a follow to learn more about the cannabis industry.